Hello, and welcome to today's webinar. My name is Papa, and I will be in the background answering any WebEx technical questions. If you experience difficulties joining the WebEx session, please contact WebEx technical support at 1-866-229-3239. Please note that as an attendee, you are part of a large audience today. Due to privacy rights, however, the attendee number and list is not shown for all. All attendees will remain in a listen-only mode, and as a reminder, the call today is being recorded. We will be holding a Q&A session at the conclusion of the presentation. You may ask an online question anytime by simply clicking on the Q&A panel located in the lower right corner of your screen. Please send your questions to all panelists. And with that, we invite you to sit back, relax, and enjoy the session. I would now like to introduce your first speaker for today, Karl E. Emerson, Montgomery, McCracken, Walking Roads, LLP. Karl, please go ahead.
Thanks very much, and I apologize to all the attendees. I had some technical difficulties logging on through a VPN, but we now got those worked out. Anyway, we're going to be talking today about the private Inurement prohibition, excess compensation, intermediate sanctions, and the IRS's rebuttable presumption, a basic primer for 501c3 public charities. Now, of course, at the beginning we have to give a disclaimer. This presentation is intended to provide only a general summary and overview of these topics as they pertain to public charities that have been granted tax-exempt status under Section 501c3 of the Internal Revenue Code. The presentation will not address the applicability of these topics to other types of tax-exempt organizations such as private foundations and those that have been granted tax-exempt status under other parts of Section 501c3 of the Internal Revenue Code. The information provided during this presentation is not to be considered legal advice applicable to any particular situation, and organizations needing specific advice and counsel on these matters should always consult with knowledgeable counsel. So the private Inurement prohibition requires that a public charity that has been granted tax-exempt status under Section 501c3 of the Internal Revenue Code operate so that none of its income or assets unreasonably benefits any of its board members, trustees, officers, or key employees. These types of individuals are commonly referred to as insiders. Thus, the prohibition precludes any of the income or assets of a charity from unfairly or unreasonably benefiting, either directly or indirectly, individuals who have close relationships with their organizations and the ability to exercise control over them. The most common type of private inurement is excessive compensation paid to insiders, and this topic will be covered in much greater detail later in the presentation. There are, however, many other forms of private inurement that can also result in the revocation of a charity's tax-exempt status and/or in the imposition of significant intermediate sanctions that will be discussed shortly. These other forms of possible private inurement include, but are not limited to, the sale of a charity's asset to an insider, the charity's purchase of an asset from an insider, the charity's rental of property from or to an insider, the charity's lending of money to an insider, and the use of facilities and/or other assets of the charity by an insider. Just as with assessing the appropriateness of an insider's compensation, the decisive factor in determining whether a transaction with an insider violates the private inurement prohibition is whether the transaction is fair and reasonable under the circumstances. For example, it would not necessarily be improper to sell a charity's asset to an insider at or above its fair market value. It would, however, probably be improper to sell a charity's asset to an insider for less than its fair market value. Similarly, it would not necessarily be improper to rent a charity's office facilities from an insider at or below fair market value, but it would be improper to do so for more than fair market value. Likewise, it would not necessarily be improper for a charity to purchase assets and/or services from an insider or from an entity with which the insider or a family member is affiliated, as long as the assets and or services are purchased at or below their fair market value rather than for more than their fair market value. The courts and the IRS have consistently ruled that any unreasonable benefit or inurement, however small, is impermissible and can result in the revocation of a charity's tax-exempt status. However, even if private inurement is clearly present in a particular fact situation, it can often be argued that the ultimate sanction of revoking a charity's tax-exempt status should not be imposed if the unreasonable benefit is incidental or insignificant. In such instances, a strong case can be made to only have the intermediate sanctions that will be discussed shortly imposed instead of revoking the charity's tax-exempt status. As was noted earlier, the most common type of private inurement is the payment of excessive compensation to insiders. The IRS has significantly increased its enforcement efforts in this area and recently assessed millions of dollars in penalties for these types of violations. In addition, the IRS has indicated that it will now include excessive compensation analysis in every future audit it conducts. It's important to note, however, that individuals working for a charity are not required to donate their services and are allowed to be reasonably compensated. In other words, they're not required to work for free or accept reduced compensation simply because they provide their services to a charity rather than to a taxable organization, although such individuals often do. The private inurement prohibition simply requires that the total compensation paid by a charity to an insider be fair and reasonable. Whether an insider's total compensation is fair and reasonable is determined on a case-by-case basis using a process similar to that used to value anything. This process requires a charity to gather comparable data regarding what similarly situated individuals running similar organizations are paid. There are numerous sources for obtaining this comparability information. For example, ERI Economic Research Institute at www.erieri.com and GuideStar at www.guidestar.org are two excellent sources of this comparability data. For an insider's compensation to be fair and reasonable, there must be an approximately equal exchange of benefits between the charity and the insider so that the insider does not receive an unreasonable or unwarranted benefit from the charity. Bruce Hopkins, a nonprofit law expert, notes that there are several factors commonly considered to evaluate the reasonableness of an insider's compensation, including the compensation paid by similar organizations, both exempt and taxable, for equivalent positions in the same community or geographic area, the charity's need for the particular services of the person in question, the uniqueness of the person's background, education, training, experience, and responsibilities, whether the compensation was approved by an independent board of directors, the size and complexity of the charity's income and assets, and the number of employees the charity has, the person's prior compensation arrangements, the person's job performance, the relationship of the person's compensation to the compensation paid to the charity's other employees, and lastly, the number of hours the person spends performing his or her job. It's important to note that total compensation paid by a charity to an insider includes more than just the insider's salary or wages. It includes all other forms of compensation the insider receives, such as bonuses, commissions, royalties, fringe benefits, deferred compensation, severance payments, retirement and pension benefits, expense allowance, and insurance benefits. The bottom line is that an unreasonably large or excessive salary paid by a charity to an insider can be considered private inurement, especially when the insider also receives other forms of compensation from the charity. It's important to note, however, that very large salaries and non-cash benefits paid to certain key employees can often be reasonable when one considers the employee's experience and expertise. For example, highly skilled and experienced physicians at nonprofit hospitals are sometimes paid significantly more than the hospital CEOs and other executive-level staff. According to nonprofit law expert Bruce Hopkins, a charity can avoid violating the private inurement prohibition for compensation it pays to an insider as long as it's able to describe fully and accurately all aspects of the insider's total compensation package, explain exactly how the charity determined the insider's total compensation package, describe adequately and accurately the insider's duties and responsibilities, provide adequate documentation such as comparable salaries paid by similar organizations that show the reasonableness of the insider's compensation, show through appropriate documentation that the charity's governing board approved the amount of the insider's compensation and that the insider or someone related to the insider did not participate in the process. Show that the amount of the insider's total reportable compensation agrees with the amount reported on the insider's Form W-2 or Form 1099 to avoid an automatic excess benefit transaction, and then show through appropriate documentation that the insider's use of any of the charity's assets, such as cars, real estate, credit cards, laptops, or cell phones, for other than fulfilling the charity's exempt purposes, were properly included in his or her compensation and properly included in the insider's Form W-2 or Form 1099, again, in order to avoid penalties for automatic excess benefit transactions. As was noted earlier, not all findings of private inurement will result in revocation of a charity's tax-exempt status. Section 4958 of the Internal Revenue Code provides for intermediate sanctions that allow the IRS to impose significant taxes on insiders, whom the applicable regulations refer to as disqualified persons, when they engage in excessive benefit transactions with a charity. Therefore, Section 4958 gives the IRS authority to impose a sanction short of revocation when revocation would be inappropriate and or unnecessarily harsh. In an excessive compensation case, the excess benefit is the amount by which the total compensation paid by the charity to an insider exceeds the reasonable value of the services provided by the insider to the charity. So, for example, if a comparison of relevant salaries shows that an insider is being paid $100,000 more than comparable individuals performing similar functions at similar organizations, and that there's no legitimate reason for doing so, the amount of the excess benefit received by the insider would be $100,000. Section 4958A1 of the Internal Revenue Code imposes an initial tax equal to 25% of the excess benefit. The insider in this example would have to pay a $25,000 penalty to the IRS, as well as make the charity whole by repaying the $100,000 plus interest. If the insider does not make the charity whole within the time frame set by the IRS, Section 4958B of the Internal Revenue Code imposes an additional tax equal to 200% of the excess benefit on the insider, an additional $200,000 penalty in the current example. Section 4958A2 of the Internal Revenue Code also imposes a tax equal to 10% of the excess benefit on any charity manager, typically a board member, who knowingly approved the excess benefit transaction unless his or her participation was not willful. Again, in the above example, the tax on any board member who knowingly approved the unreasonable or excessive salary would be $100,000. It's important to note that participation includes a board member's silence or inaction where he or she is under a duty to speak or act, as well as any affirmative action by the board member. A board member is not considered to have participated in an excess benefit transaction, however, if he or she opposed the transaction by, for example, having his or her objection to the transaction noted in the charity's board meeting minutes. In addition, a board member's participation will not normally be considered to have been knowing within the meaning of Section 4958A2 if there was full disclosure of all relevant facts to an appropriately qualified professional and the board member relied on a reasoned written opinion of that professional that the transaction in question was reasonable. To help charities comply with this sometimes complex area of the law, the IRS has established a rebuttable presumption that payments to insiders are presumed to be reasonable and not excessive if the following steps were taken. First, the charity's board obtained and relied on appropriate comparability data prior to making its decision. The total compensation package was approved in advance by the charity's board, and no individuals who had an actual or potential conflict of interest with respect to the compensation arrangement participated in the deliberations. And then three, the charity's board adequately and contemporaneously documented the basis for its determination. If the above three steps were taken, the IRS may only rebut the presumption of reasonableness if it can show that the comparability data relied upon by the charity's board was inappropriate. For charities with annual gross receipts of less than $1 million, a board is considered to have had appropriate comparability data if it had data on compensation paid by three comparable organizations in the same or similar communities for similar circumstances, for similar services. So in conclusion, in this age of significantly heightened scrutiny of the charitable sector by both state and federal regulators and Congress and the media and donors, it's especially critical that a charity take all necessary steps to ensure that it doesn't violate the private inurement prohibition by paying one or more of its officers or employees excessive compensation. Not to do so can jeopardize the charity's tax-exempt status and or result in the imposition of significant financial penalties against those determined to have been excessively compensated, as well as against those who knowingly approve the excessive compensation. Given the fact that the IRS has significantly increased its enforcement efforts in this area and recently assessed millions of dollars in penalties for these types of violations, and has indicated that it will be routinely including excess compensation analysis in every future audit it conducts, a charity that fails to follow the basic steps suggested by the IRS to ensure that the compensation it pays insiders is reasonable and not excessive is acting irresponsibly, and its directors may not be properly exercising their fiduciary responsibilities. In addition, a charity's failure to follow these basic steps for determining compensation for insiders will now be public information because ever since 2008, a charity has to indicate on its annual IRS 990 return whether it followed these steps in determining the compensation of its insiders and other employees. Consequently, a charity will want to consider carefully how it answers all of these questions. And so now at this time, that concludes our brief overview of the law in this area, and then Chuck McLean now is going to take over, and he is going to describe the products that GuideStar has available that can help you make sure that your executives and other employees are being reasonably compensated, and so that you can avoid intermediate sanctions.
Thank you, Karl. So I'm going to talk to you a little bit about the compensation report that GuideStar produces. I want to point out that this is not a survey. This is based solely on Form 990 data that has been filed under penalty of perjury. I look at both total compensation for an employee, and also in certain circumstances we're able to match up incumbents. And so we'll look at annual percentage increases. The 2013 report uses more than 135,000 positions from more than 94,000 organizations. There are 501c3s of all types other than private foundations. Because the time lag in filing, this uses 2011 data rather than 2013 data, which you'd love to have, but Form 990 doesn't work that way. We have 14 positions that we report on. Of course, as you might imagine, the CEO and executive director is the position that an organization is most likely to report on the Form 990. And that's followed usually by Chief Financial Officer, CFO position. You know, obviously there are a lot more positions listed on some 990s than this, but we've tried to slice and dice this in enough ways that you can get some sort of more detailed data. And when you start to slice and dice positions which appear very infrequently on Form 990, you run into questions of statistical significance. So over the years, these are the 14 positions that we have found that we can usually get enough data to say statistically meaningful things about. We do break down the data by geography, and that's both at the national, state, and MSA level. Again, because of the issues of statistical significance that I'm talking about, the data is going to be much richer for the national level than it's going to be at state and MSA. We break these organizations into categories based on their annual expenses on Form 990. We do what we can to assign a gender to the individuals, and the reason we do that is because there's still a persistent gender gap in wages in the nonprofit sector. And this is something that we're very interested in, and we want to continue tracking it. Obviously, this is an inexact science. When we have a name like Pat or Chris, names like that, we're not able to assign a gender to them. So we don't do any guessing here. Juliet is going to be coded as a female, and Bob is going to be coded as a male. We also look at organization types. The NTE coding system breaks things down at 3 different levels. At the top level, 26 codes like arts, culture, humanities, education, and so on. At the secondary level, you would have museums, perhaps. And then at the 3rd level, it would be art museums, science museums, history museums, and so on. So we do use all 3 levels of that to discuss the data in our report. We report the number of organizations in every category, the average compensation for the position across that category, and then we look at the percentiles, the 10th, 25th, 50th, which is the median, 75th, and 90th percentiles. If you're not familiar with what percentiles are, they basically just say, okay, this is the dividing line between people lower than this and higher than this. So, for example, the 10th percentile is the number such that 10% of the people in the report made less than that, 10% of the people in the report made more than, or 90% of the people made more than that. I'm very skeptical about using the averages in this report, which is why we print all of the percentiles as well. In some cases, we're going to end up with a lot of organizations in a category. In other cases, we're going to have many fewer. And so when you have fewer organizations, the average is really susceptible to being skewed. So, you know, we prefer the percentiles, but also one thing that you can look at in the report is that generally speaking, when the median and the average are fairly close together, then that means that you have more well-behaved data that's not being jerked around by outliers either on the low end or on the high end. Just to give you a few pages that describe the kinds of things we have here. Compensation here for the arts, culture, and humanities by budget size and by gender. There are state statistics by major group, NT major group, and budget size. Here we have the NT decile group, which is the second classification. Here's an example of a page with MSA data on it. And as I said, we are also able to do name matching from year to year, name and position matching, and calculate increases for incumbents. So we're looking at people who have the same name and the same job at the same organization, and we do calculations on what the pay increases from 2010 to 2011 in this particular case were. This report is most useful for kind of getting reality checks for executive compensation. If you have a situation where you're going to have a very complicated pay package and you're anticipating compensation that's well above normal, then this is probably not going to be sufficient from the perspective of the IRS. So if you're going to go out there and pay somebody $350,000 a year when the median income for organizations like that is $150,000, you need to have some really good reasons and some really good documents explaining why you think that that's reasonable compensation. But for an example here, let's say that you have an organization that provides human services, has an annual budget of $5.3 million, and is in Boston, Massachusetts, with an experienced executive director being sought. And there's the typo that I missed. Looking in the GuideStar report, you'd find 93 organizations in Boston, not Detroit, where the executive director pay is about $122,000 at the 25th percentile, around $152,000 at the median, and about $227,000 at the 75th percentile. So that kind of gives you an idea of where compensation lies. And you know, if you're looking to find reasonable compensation for a person, and that will give you what looks like reasonable compensation. And again, if you're going to be looking to do compensation packages that are significantly higher than these norms, that's something that you're going to need to really document very well to satisfy the IRS. Rules to live by. The best source of compensation data that the IRS has is Form 990 data. So when they're trying to figure out what's reasonable, they're going to be looking at Form 990 data. The more unusual compensation is, the more likely the IRS is to question it. It's looking for nails whose heads are sticking up. And the more rigorous the organization needs to be in following proper procedures when they're documenting what might appear to be excessively high compensation. So, you know, as Karl said, it's not against the law for people who work at nonprofits to get paid, and it's not against the law for them to be paid well, as long as it's appropriate and as long as the organization can document that the pay is appropriate. We have a few questions that have been asked in the past that we've already got here canned, and I see that some have been coming in while we've been at this. So, Karl, I'll let you take a hack at this one. What kind of compensation practices can a for-profit engage in that a nonprofit can't?
Well, of course, a for-profit is responsible to its shareholders. I mean, there still are limits, but generally, for-profit entities can get away with paying their executives significantly more than a nonprofit. One of the points that I want to make sure that we make here is that both Chuck and I have been talking about your principal concern being that the IRS might come after an individual or an organization for paying excessive compensation, and it's important to know that all the various state attorney general's offices can also institute excessive compensation cases. They can actually come after an organization or an individual within an organization if they feel that the person has been excessively compensated as well. So I just wanted to make sure we made that point as well.
No, that is definitely a good point, Karl. How has the economic downturn affected compensation practices? I think that based on what I saw with the 2011 data, that things are starting to come back. Increases over 2010, from 2010 to 2011, were bigger than they were since the recession. They still, for that time period, had not reached what I guess would be considered normal, which in most cases was in the 3% to 6% range. And the way those usually arrange themselves, the smaller the organization, the smaller the increases. You're seeing the 5–6% increases mostly at the larger organizations, and the practice of the rich getting richer. It'll be interesting to see. I don't think that we're all the way back yet. I can't wait to look at the 2011 to 12 data and the 12 to 13 data. But I think that increases are starting to come back, but mainly they're still, you know, as of at least 2011, they were still somewhat subdued. We are in a rural area and there are not other nonprofits like us nearby. How can we choose comparable organizations for the purposes of benchmarking compensation? You know, you look for other rural areas that are not nearby. Certainly cost of living can vary dramatically from region to region, but you know, if you don't have a lot of nearby comparables, look for a community that is like yours, that has an organization like yours. Anything you would add to that, Karl?
No, I think you covered it there. I mean, you want to make sure, again, that you take advantage of these sources of information out there through GuideStar and ERI.
Mm-hmm.
The thing is looking at similar organizations and similar positions in other areas.
One of the questions that come in while we've been talking, why are private foundations excluded from the data? The reason I don't include private foundations is basically there aren't a lot of people who work for private foundations. You know, it's easy to think of the Ford Foundation and the Gates Foundation and people, organizations like that. And yeah, they have plenty of people who work for them, but it's amazing how quickly the assets and paid employees of private foundations goes down. You know, the top 1,000 private foundations, and there are about 100,000 private foundations now. The top 1,000 private foundations have an overwhelming proportion of the assets. So generally I exclude private foundations because I don't get enough compensation data to talk about it. So let's see, what else we got here? Karl, there seems to be some confusion about what an insider really is. Would you go over that again?
Well, basically an insider, or as the intermediate sanctions refer to as a disqualified person, it's anybody that has the ability to exercise control over the board or the affairs of the organization. So it would definitely include the board members. It would include all the key executive staff, you know, the president, the vice president, the secretary, the treasurer, chief financial officer, basically anybody that has the ability to exercise control over the organization or influence it.
Okay. A question: at what dollar level do you have to report 990s? Concerned that under concerned that under 1 million the pool of info is limited. That's actually not the case. We have compensation data for organizations with revenues of $50,000 and up, and the overwhelming majority of the organizations are actually between 50,000 and 1 million. You know, in the real world, 1 million may seem like chump change, but in the nonprofit sector, the distribution is still very much skewed to smaller organizations. A $1 million organization is pretty sizable, actually. So we have a lot of data on organizations that are have expenses under $1 million. Is comparative compensation data available somewhere at no cost? Well, it depends on how much you want to dig. If you have an organization that you know who your comparables are, I was about to say competitors, I should say comparables, then you can certainly go and get the Forms 990 at GuideStar at no cost and, you know, do your own compensation analysis. Whether there's any place where you can get this all wrapped up and tied in a neat bow for free, I don't think so. So, you know, if you want to do this, certainly the data is out there at GuideStar, but, you know, you'll have to do the dirty work for yourself.
There are a couple of other questions.
Go ahead, Carl.
One of the questions that says, is it a conflict of interest for a compensated executive director to serve on the board of directors? I don't believe that that in and of itself is a conflict of interest, but as I mentioned, when it comes around to determining what the salary is going to be for the executive director each year, or however frequently you set that, the executive director and anyone related to the executive director cannot participate in those discussions. So you definitely would want to make sure that anybody that you're determining their salary, that they cannot be in there as their potential salary is being discussed, or a family member.
Okay, Carl, I don't have any clue about the next one. Do you have someone speak to the valuation of non-salary benefits? By whom, how often, to what extent should this be done for each top staffer? I haven't a clue on that.
Well, I mean, the key thing there is that when they're looking, if you're under investigation by either the IRS or a state attorney general's office for allegedly being excessively compensated, the key point you got to keep in mind is that they're not just going to be looking at your salary. They're not just going to be looking at your paycheck. If you're provided with a vehicle, if you're provided with cell phones, laptops, other types of things like that, they're going to look at your total compensation package. And I guess in terms of who values that, it's the fair market value of those things.
Okay. So, but you would say then that that's something that somebody should really be doing every year.
I mean, you basically, the key thing is to keep in mind that if spotlight falls on you, they're going to be looking at your total compensation package, not just what you bring home in your paycheck every week. And you got to make sure that the total package is reasonable. It's certainly possible that you could have a situation where the IRS and or an attorney general's office would conclude that the salary that the person is being paid is not excessive. However, when you add in all the additional fringe benefits and additional perks that the person receives, that when you add that total compensation package together, they've been excessively compensated. You know, the thing that you want to keep in mind, and the reason that it's so important to make sure, or at least be able to show the IRS and or an Attorney General's office that you have made a good faith effort to make sure that your employees are only being reasonably compensated, is from the simple example that I used, the consequences can be pretty hefty. I mean, I'm aware of individuals that initially have been asked to pay back 2/3 of what they made over a 10-year period. I don't know how many of us, no matter what you make, would be able to pay back that kind of money, you know, 2/3 of what you made over the last 10 years. So it's very, very important for you to make sure that the total compensation package is reasonable.
Okay. There's a question here. What is the criteria for reporting employee compensation on the 990, i.e. top 5 employees? How can you get 14 positions reported on and have statistically sound data? Well, as to the first question, it's not quite true anymore since the redesign of Form 990 in 2008 that you're only reporting on the top 5 employees. Depending on circumstances, you can report on a lot more employees than that. As far as how can you get 14 positions reported on and have statistically sound data, you know, there's no question that this data is richest for the CEO, executive director position, because virtually everybody's got one of those that we can identify. And it thins out from there, still pretty good coverage from the CFO, but you know, it's absolutely the case that if you're trying to get information about development directors in Williamsburg, Virginia, where I'm sitting right now, we're not going to have anything in the report about that. We don't have enough development directors or charities that are large enough to have development directors to report at that level. So, you know, what we do in this report is we take the data, we slice it as thinly as the number of observations allows us to. So we can definitely report on what does it look like for development directors at a national level, and in most cases at a state level. But yeah, when we get down to development directors at art museums in Roanoke, Virginia, there's not going to be anything there. It's not that rich a data set. We'll have something about CEOs, but you know, not about development directors. So, you know, it's a good question. We cut it as deeply as much as we can, but you know, for every category, we're just not going to be able to display data because there won't be enough there.
There's another question right after that where it says, can the principal of a charter school charge rent to the charter school for unimproved land the principal owns? And again, as we mentioned, there's nothing inherently wrong with doing business with an insider. The transaction, though, has to be reasonable and fair and appropriate for the tax-exempt entity. So in this particular instance, you would definitely want to make sure that, first off, that there's a genuine need to actually, for the school to rent the unimproved land, and then you would want to make sure that the insider is not being paid anything more than fair market value. Ideally, you'd want the principal to be being paid somewhat less than that to cover yourself, and you definitely would not want the principal or any other insider being paid more than the fair market value, because in the extreme example, the tax-exempt status of the organization could actually be revoked. But then again, even if they don't do that, they could impose these intermediate sanctions, and again, they're pretty hefty, the penalties.
Okay, we're running out of time here. One that looks interesting to me, does a nonprofit paying under $100,000 or whatever the magic number or percent is, with an annual budget under $2 million, have to worry about excessive compensation? Now, Karl, I would say nah, but you're the one who's the former state regulator. You tell me.
What, $1 million budget and the executive director's
A $2 million budget, and yeah.
Well, again, a lot of that just depends on the perception of the regulator. Right? The key thing is you ideally want to be able to show other similar types of organizations where someone with those kind of responsibilities for a similar organization is getting paid close to that. You know, we want to make sure that you also understand you certainly can pay more than what the average is. The key thing, though, that you have to remember is that if you're going to pay somebody significantly more than what comparable people are being paid to run similar types of organizations, you better have all your ducks in line and have all your appropriate justification there for why you're paying this person, you know, $50,000 or $100,000 or $200,000 more than people running similar comparable organizations. It's not a foregone conclusion that the person who's making $100,000 more than people in comparable positions is excessively compensated. There might very well be appropriate justification for that.
Right. All right, well, Karl, I want to thank you very much. We're running out of time here.
Again, I apologize for the technical problem. If someone else has questions that they want to send me directly, I'm happy to try to answer them for them.
And there are the email addresses.
All right, well, thank you very much, our speakers today, and our presenters for a great presentation, and thank you all for joining us. This just concluded the webinar. You may now disconnect your line. Thank you again, and have a great day.